Finding quality growth stocks doesn't always mean paying premium prices. While many investors focus exclusively on expensive, established names, there's a segment of the market that's often overlooked. Legitimate, high-growth companies trading for under $10 per share. These aren't penny stocks or speculative gambles. These are real businesses with actual revenue, clear growth trajectories, and compelling reasons to consider them for your portfolio. Today, I am breaking down 3 stocks under $10 that caught my attention based on recent financial data and analyst coverage. And make sure you watch until the end, because the third pick on this list might genuinely surprise you with what it is doing right now in the rare disease treatment space. Before we get started, this is not financial advice. I'm sharing my research and analysis, but you need to do your own due diligence and consider your personal financial situation. These stocks carry risks, and past performance doesn't guarantee future results. Let's set the stage. Stocks trading under $10 represent a very mixed part of the market. Some are regional players, some are early-stage tech companies, and some are established businesses in niche industries. The key is separating legitimate growth opportunities from companies trading at low prices for the wrong reasons, like serious financial distress or dying business models. What we're looking for are businesses with strong revenue growth, improving fundamentals, and clear catalysts that could reasonably drive their stock prices higher. The stocks I am covering today meet specific criteria. They are all trading under $10 as of December 2025. They've demonstrated meaningful revenue growth, they have positive analyst coverage, and they operate in sectors with real growth tailwinds behind them. Stock number 1: SoFi Technologies, the fintech disruptor. Let's start with stock number 1. SoFi Technologies, ticker symbol SoFi. Now, here's where things get interesting. SoFi is no longer under $10. It's currently trading around $27 to $29 per share as of early December 2025. So why is it in a stocks under $10 video? Because for a long time, SoFi was under $10. And in the last stretch, it's exploded. The stock has jumped roughly 100% year to date in 2025. Which is exactly the kind of move you buy growth stocks for. It's a perfect example of what can happen when a quality sub-10 name finally gets re-rated by the market. SoFi started as a student loan refinancing company, but it's evolved into a full digital financial services platform. Think of it as a one-app ecosystem for your money, banking, personal loans, credit cards, investing, even insurance. The numbers are strong. SoFi reached about 6.9 million members in the third quarter, representing roughly 47% year-over-year growth. Revenue is projected to climb around 30% in 2025 to hit approximately $2.05 billion, with expectations of about 23% growth in 2026 to reach roughly $2.53 billion. On top of growth, the quality of the numbers is improving. SoFi has posted smaller than expected quarterly losses for multiple quarters in a row, showing better cost control and a path toward real profitability. They're expanding their member base and monetizing those relationships more effectively over time. The bullish case here is built on a few pillars: a one-stop, integrated approach to consumer finance, strong, consistent member growth, the long-term shift away from traditional branch banking toward mobile-first experiences. It's not a Warren Buffett stock, but the idea of owning a financial super app has worked in other markets. SoFi is trying to be that for you, as consumers. Now, the risks. The fintech space is brutally competitive. SoFi is fighting traditional banks going digital, well, they're fintechs, and big tech adjacent platforms. Its loan portfolio is also exposed to macro conditions. If the economy weakens, credit losses can climb. And because the stock has already run hard, valuations are elevated, which means short-term upside could be limited if growth slows or sentiment cools. Stock number 2: Nu Holdings, the Latin American banking revolution. Stock number 2 is Nu Holdings, ticker NU. Nu is currently trading around $17 per share in December 2025, and it's had an impressive ride. The stock has climbed about 66% in 2025 alone. Nu, also known as Nubank, is essentially the Sophie of Latin America but on steroids in terms of scale. It operates primarily in Brazil, Mexico, and Colombia, targeting a huge unbanked and underbanked population across the region. Let's look at the growth. Over 105 million customers, up about 25% year-over-year. Average revenue per active customer of roughly $11.2 in the second quarter, up about 30% year-over-year on a currency-neutral basis. Revenue for 2025 is expected to reach approximately $5.51 billion, representing close to 48-49% growth compared to the previous year. Net income through the first 9 months of 2025 was just under $2 billion, up about 39% year-over-year. And here's a key credibility signal. Berkshire Hathaway, Warren Buffett's company, owns roughly 2.2% of Nu, a stake valued around $1.7 billion. That doesn't mean the stock is risk-free, but it does show that serious long-term capital believes in the story. The unit economics are excellent. In the third quarter, Nu generated around $13.4 in average monthly revenue per customer while spending only $0.9 to serve them. That kind of spread shows just how scalable the model can be. The bull case here is straightforward. Latin America's rising middle class, a massive underbanked population, a modern, digital-first bank with strong brand recognition and low servicing costs. But again, risks are real. Nu is exposed to macroeconomic volatility in Brazil, Mexico, and Colombia, things like inflation, interest rate shifts, and recessions. There's currency risk when converting local earnings into dollars. Regulatory changes could reshape the banking landscape, and competition is heating up, especially from MercadoLibre's Mercado Pago, which is also rapidly expanding financial services. After a big run-up, Nu's valuation is less of a bargain than it once was. So while the growth story looks strong, investors need to be aware they ray not early anymore, they ray somewhere in the middle of the adoption curve. Stock number 3, Amicus Therapeutics, the rare disease specialist. Now for stock number 3, this one is actually still under $10. Amicus Therapeutics, ticker symbol FOLD. Amicus trades around $9 to $10 per share, and lives in a completely different universe compared to Sophie and Nu. This is a biotechnology company focused on rare diseases, specifically Fabry disease and Pompe disease, both serious genetic disorders with relatively small patient populations, but very high unmet medical need. Amicus has 2 commercial products, Galafold, the first oral precision medicine for Fabry disease, Pombiliti, plus Opfolda, a 2-part treatment for late-onset Pompe disease. Now, let's talk numbers. Amicus reported total revenue of about $528.3 million in 2025, marking roughly 33% year-over-year growth. Galafold generated around $458.1 million, growing about 18% year-over-year. Pombiliti plus Opfolda contributed about $70.2 million in their first full year of commercialization, a huge milestone. The company reached non-GAAP profitability in the third quarter, with net income of roughly $30.8 million. That's a big shift from the always burning cash phase that many biotechs live in for years. Looking ahead, Amicus projects 2026 total revenue growth in the high teens to mid-20s% range. Internally, they expect Galafold to grow somewhere around 10-15%, Pombiliti plus Opfolda to grow roughly 65-85% as adoption ramps up. What really reduces risk here is a patent settlement with Teva Pharmaceuticals. That agreement helps protect Galafold's U.S. market exclusivity until January 2037, which gives Amicus more than a decade of visibility on its primary revenue driver. Management expects to surpass $1 billion in total sales by 2028, and they anticipate achieving positive GAAP net income in the second half of 2025 and beyond. The bullish case: strong, growing revenue from 2 commercial products, long intellectual property protection on the flagship drug, expanding approvals in new regions. A clear path to sustained profitability, but biotech is never a smooth ride. Risks include Regulatory shifts and pricing pressure from insurers and government payers, heavy dependence on just two main products, concentration risk, potential competition from other rare disease drug developers, the ever-present risk of safety issues, label changes, or negative clinical data. One bad headline can hit biotech valuations hard, so anyone investing here needs to be comfortable with volatility. Bigger picture risk check. Let us zoom out for a second and talk about the broader risk profile of stocks in this range. Stocks trading under $20 per share often are more volatile than large, established blue chip names have lower trading volume, which can mean wider bid-ask spreads and harder entries or exits are in earlier growth phases, where profitability may still be developing. They can offer outsized upside, but they're also more sensitive to interest rate changes, shifts in investor appetite for risk, sector sentiment, and headlines. When rates are high, many investors rotate out of growth and into safer, cash-generating companies. When sentiment swings back, these kinds of names can outperform, but timing that is never guaranteed. Final thoughts plus outro to recap. SoFi Technologies shows what can happen when a quality sub-10 growth stock finally gets recognized. It's now a scaled U.S. fintech platform with strong member and revenue growth, but it trades at a richer valuation after a big move. New Holdings is riding the wave of digital banking adoption across Latin America, with impressive customer growth, strong unit economics, and backing from Berkshire Hathaway. Huge upside potential, but tied closely to regional macro and currency risks. Amicus Therapeutics gives you exposure to the rare disease biotech space under $10, with growing revenues, commercialized products, patent protection into 2037, and a roadmap toward sustained profitability, plus all the volatility that comes with biotech. None of these are guaranteed winners. They all carry meaningful risk, but they share three things: strong recent financial performance, clear growth catalysts, valuations that can still make sense relative to their growth stories, especially if you're thinking in years, not weeks. As always, do your own research, understand your risk tolerance, and never invest money you can't afford to lose. These are growth plays, not safe, slow dividend giants, so position sizing and risk management matter. If you found this breakdown helpful, hit the like button and subscribe so you don't miss future deep dive analysis like this. Drop a comment below and tell me, which of these three stocks do you think has the most potential over the next 5 years, and why? Or is there another under 10 growth stock you want me to look at in a future video? Thanks for watching, take care of your money and your mindset, and I'll see you in the next video.